Confused about annuities? You are not alone. Today I am breaking them down in the simplest possible way. So by the end of this video, you will know exactly what an annuity is, how they work, and whether it might fit into your retirement plan. What is an annuity? An annuity is a contract between you and an insurance company. You give them money, either in a lump sum or in payments over time, and if you choose, you can turn on income in the future. Think of it as creating your own personal pension, designed to pay you for life or for a set period of time. The funds used to purchase an annuity are called a premium, and those funds can be qualified or non-qualified. Qualified money is money from, say, a 401k or IRA, money you have not paid taxes on that you roll over into an annuity. Non-qualified money is money you have already paid taxes on, like a Roth IRA or money from your checking or savings. Why do people buy annuities? Well, people buy annuities for three main reasons: security, retirement income, and tax deferral. To protect your 401k or IRA from stock market losses, you can roll it into an annuity where you can never lose your principal or interest earned. Maybe you want a guaranteed income for life, for a certain period of time, or a specific return. Your money grows tax deferred until you start taking income. There are four basic kinds of annuities: fixed, fixed index, variable, and immediate. With a fixed annuity, you put in a lump sum premium, and your money grows based on a guaranteed interest rate. A Myga, which stands for multi-year guaranteed annuity, they're like a CD but with a higher interest rate, and they are tax deferred. You put in a lump sum premium for a predetermined period of time, typically between 2 and 10 years. The interest rate on a Myga is higher than that of a traditional fixed annuity, making it an attractive option for people looking for dependable, guaranteed growth. It is not recommended long-term since interest rates change frequently. However, when interest rates are high, annuity rates are high. And right now, in 2025, we are seeing some of the highest annuity rates in years. At the end of the contract term, you can either convert it to a guaranteed income stream for life, or you can take the money out and just walk away with it. A Spia, which stands for Single Premium Immediate Annuity, is also referred to as an immediate annuity and an income annuity. You put in a lump sum premium and decide if you want a guaranteed income for life or for a certain period of time. And then that income starts immediately or within 12 months. Let's say you invest $200,000 in an immediate annuity, and the contract provides for a 5.63% annual income. But after 20 years, the annuity is fully depleted. The insurance company will continue paying you the agreed upon annual income benefit, in this case, $938 a month. 200,000 times 5.63% equals $11,260. Divided by 12 months equals $938 a month. If you passed away and only half of the premium was returned to you, your heirs will be entitled to a death benefit of $100,000. With an index annuity gives you the chance for more growth than a fixed annuity, but with protection from market losses. There are no fees unless you add a rider. Most insurance producers will add a lifetime income benefit rider, typically at a cost of around 1.5%, which basically creates a separate income account that grows by a guaranteed percentage, for example, 6 to 8% annually. This account is only used to calculate your future income, not your cash value. Later, when you decide to start income, the insurance company will pay you a guaranteed amount every year for the rest of your life. The rider is like attaching a personal pension to your annuity. Even if the market does poorly or your account value runs out, your income checks keep coming as long as you live. The income payments from a deferred index annuity are typically higher than that for an immediate annuity because the funds have had time to accumulate interest. A variable annuity invests directly in the stock market. There is no 0% floor, so you can lose money. They are loaded with fees and risky. So when you hear Dave Ramsey or Ken Fisher or Susie Orman say annuities are bad, they're referring to a variable annuity. Funding an annuity. You can fund an annuity with one single lump sum premium or multiple premiums. Funding can come from rolling over a 401k or IRA, or from a Roth IRA, or money from your checking or savings account. Also, if you fund an annuity with qualified money, the income you receive from the annuity will be fully taxable. If you fund an annuity with money you've already paid taxes on, you would only pay taxes on the interest earned. The agent's commission is not deducted from your premium. That's because the insurance company is counting on you leaving your money with them long term. If you don't keep your money with them long term, or if you want access to more than 10% of your account value in the first 7 to 10 years, that's during the surrender period, you will be charged a surrender charge. And this is just one of the ways insurance companies can pay agent commissions without charging you. Surrender charges. Surrender charges usually start out at 10% the first year, 9% the second year, and so on. That said, the surrender charge would be waived under the following circumstances. If you require home health care services as a result of not being able to perform 2 out of the 6 activities of daily living, like bathing and dressing, if you are diagnosed with a critical or terminal illness, or if you are confined to a nursing home for at least 60 consecutive days. When you die, your beneficiary will only pay taxes on the difference between the principal and the current value of the account. But your 401k will be taxed twice. Once when you die, death taxes, and again when your beneficiary accepts the proceeds, inheritance tax. And if you take a withdrawal before the age of 59 and a half, not only will you pay taxes on the gains, but you will also pay the 10% IRS penalty for early withdrawal. When you purchase an annuity, there is a right to examine, or a free look period, which is usually between 10 to 30 days, depending on your state. This gives you the right to return your policy for a full refund for any reason. No questions asked. Afterwards, you can cancel the contract at any time, but you will incur a surrender charge. Annuities are not FDIC insured, but compared to commercial banks and investment firms, life insurance companies' solvency record has been nearly faultless, even during hard economic times. A large percentage of the life insurance companies that exist today have been around for well over 100 years. In the 2008 financial crisis, 465 banks failed, but only one life insurance company did, and that was AIG. Why? Because life insurance companies are regulated by state insurance departments, not Washington. States enforce some of the strictest rules in finance. Insurance companies must keep $1 in reserve for every dollar they promise policyholders. Banks only keep about 10 cents for every $1 deposited. On top of that, state regulators run annual solvency tests to make sure insurers stay strong. To sum everything up, the pros are guaranteed income, protection from market losses, and peace of mind in retirement. The only con is they are not liquid like a savings account. The bottom line, annuities are not a one-size-fits-all, but if you want retirement income you cannot outlive, or a safe place to grow your money without market risk, annuities can be a powerful tool. If you found this helpful, hit like and subscribe, and drop a comment below with your questions. And if you want to see how an annuity could work in your retirement plan, Head over to my website to schedule a free consultation. The link is in the description below.